Greetings, accounting students. Recently, I created a clip where I focused on the twofold effect of transactions that affect A, L, and OE. So as promised, consider this part 2 of that collection. So if you want to check out that video, by all means, go for a search on my channel. In this clip, I want to present this in a way that is visually simplistic in terms of the twofold effect of transactions that affect revenue and expenses. And the most simplistic way I can think of is to focus on a T form of balance sheet. So before we get into that, a bit of emphasis on the accounting equation, because on the left side of the equation, we've got our economic resources that will provide a future economic benefit in terms of our assets, which equal the right side of the equation, which are the claims, the equities of those assets. So we've got the external claims being the liabilities and the owner's residual claims in terms of the owner's equity. And what's missing in terms of the 5 elements on this image is what about elements 4 and 5, revenue and expenses? So keep in mind that as I'm going through this in a practical sense, what we would do is, first of all, we prepare our income statement, we report all of our revenue, we would then deduct our expenses, and then we would calculate our consequential net profit, and then that would be posted to our balance sheet in the owner's equity section, because that would result in a change in the owner's residual claims on the assets. Alrighty, so key point. For any transaction that increases revenue, that's going to increase our profit, and an increased profit will increase the owner's residual claims on the assets. So that will be an increase in OE. The opposite for an expense. When we have an expense, it'll reduce profit. A reduced profit reduces the owner's residual claims on the assets, so that will decrease OE. So as I did in the previous clip, we're going to be bouncing back and forth from an Excel spreadsheet so we can update these in real time and highlight the twofold effect. But before we go there, let's just do a bit of background theory in terms of the twofold effects of transactions relating to expenses. So when we know that there's a transaction that's affected an expense, we just need to work out what's the other account affected. By definition, an expense results in a corresponding decrease in an asset or an increase in a liability. So when we have cash payments for expenses, we know that we've got an expense going up, which will reduce OE, and our bank balance will be going down, which will reduce assets if it's in surplus. In our course, we have a whole bunch of non-cash expenses for BDAs, for adjustments to inventory, losses, gains, write-downs, etc. And so therefore we just need to work out the other account affected so that we always have the twofold effect. The accounting equation always equals and our balance sheet always balances. So let's have a look at 3 examples. And so before we jump out of this PPT and into our spreadsheet, you might want to pause the video and just ask yourself, what are the accounts affected by these 3 examples? And then we need to think about whether our assets, liabilities, or owner's equity are going up or down as a result. So that's where we're going now. So let's jump out and move into our spreadsheet. So hopefully you can see all the numbers on your screen. Okay, so transaction number 1, we've paid electricity $100 plus there's a GST component. So so electricity is an expense. So therefore that will reduce profit, which will reduce OE. So if we go to our owner's equity section, we've got $2,000 as our current profit. We're going to deduct our $100 expense and knock that down to $1,900. In terms of the GST, 10% of 100 is 10. So when we pay for GST, it offsets the GST we collect on our sales, and that we are obliged to settle with the ATO when we do our BAS. So that GST $10 will actually reduce our balance in our clearing account by 10. So let's knock that down to 7790. Oops. Okay, 790. Alrighty. Total that up. $100 for electricity, $10 for the GST. That's 110. Anytime we have the word paid, that means we're going to reduce our cash at bank by 110. So therefore 5,800 becomes 58,690. And to highlight the twofold effects, if we look down the bottom here at our assets, they are in equilibrium with our equities, the claims on those assets. Transaction number 2, depreciation. Depreciation, the allocation of the cost of the asset over its useful life. So therefore, this is an expense that results in a decrease in assets. And so therefore, we go back to that net profit figure. And once again, we're going to reduce this because we're reducing the owner's residual claims. So 1,900 minus 5 gives us 1,400. And in terms of the twofold effect, we go over to our assets section of our balance sheet. We're not going to adjust the historical cost, which we can verify and faithfully represent. We create an accumulated depreciation account so that we can enable users to determine the carrying value of the asset over time. So we're going to enter the accumulated depreciation as a negative figure because it's reducing the carrying value. And so once again, if we check our assets and our owner's equity, they equal. So again, we need to think about the twofold effect. Third transaction is we've got a customer paying amount owing on a credit sale. So this is not revenue. We've already recorded the revenue. That would have been dealt with at the point of sale. Based on the accrual basis, we record revenue when it's earned, and that was earned when we handed over control of the goods to the customer. Now we're dealing with phase 2, when they're settling a debt. So this is accounts receivable. They're settling a $500 amount owing. So we go to accounts receivable, which is an asset, and we reduce that by 500. So 9,000 minus 500 gives us 8,500. Now the discount, because they're paying early based on our credit terms, we're going to reduce the amount they owe by 5%. 5% of 500 is 25. And this actually represents an expense because it's reducing the asset. So it's reducing the cash at bank that we would receive. It's reducing the accounts receivable balance by 25. So that's going to reduce our net profit even further. So we need to deduct 25 from that down to 1,375. And in terms of our bank, we're actually receiving 500 minus the discount. That equals 475. So let's just go up here just so I don't make an error and deduct, add 475. And yes, we still balance. So my Excel work has paid off there. Alrighty, let's go back into the PPT. This won't take much longer. Let's look at some revenue. Okay, so same deal except in reverse with expenses. This time, if we know that one of the accounts is revenue, we just need to determine what asset is being decreased or what liability is being decreased, such as our cash or credit sales, a return, a discount, an inventory gain, and adjustments for BDAs relating to revenue. So 4 examples here. Again, you might want to pause the vid and determine what accounts have been affected. This adds another layer to it when we have, particularly for number 1 and number 2, because there's a sale price effect where we've got twofold effect plus a GST, which makes it a threefold effect. And we've also got a cost price effect for a twofold effect. So for 1 and 2, you're going to have to basically adjust 5 accounts. So this is where it can get a little bit complex. So again, I'm going to jump out here. Let's go into the spreadsheet and deal with these one by one. So transaction number 1, we've got a credit sale of 30K. So that's revenue. So that's going to increase our profit. So if we go to our net profit in our owner's equity, we're just going to top that up by 30,000. So that's now 31,375. There's a GST component. So we're charging GST to our customers. So therefore that creates an obligation for us to collect that and forward that to the ATO a bit later. So 10% of 30K is 3. So go to your accounts receivable, your GST account, and top that up by 3,000. So that's now 10,790. Okay. Now, in terms of that total, 30 plus 10, that's 33. That is going to go to accounts receivable. Because that represents an asset and we're going to get a future economic benefit when they settle that debt. So 33 plus 8,500 equals 41,000. Alrighty, there's a cost price effect as well. 100% markup means that the cost of sales of this will be half of the revenue price, so 15,000. So therefore, our inventory balance, we've sold $15,000 worth of inventory. So that's going to go down to 14,800. And we have if we look at our profit, cost of sales will reduce our gross profit and consequently our net profit. So we're going to knock that down from 31 back down to 16. And again, assets equals total equities. Sales returns is literally the reverse of that. So a sales return is reported in our income statement as negative revenue. We want to keep tabs on that to provide useful information to the users of reports. So we report that separately in our income statement. So that will reduce our net profit by 200. So let's take that down to 16,175. There's a GST component. So when we collected or when we charged the GST, it increased our balance. So 10% of that 200 is being returned. So that means that's $20 less of GST that we need to pay to the ATO. So we're going to reduce that by $20. Now, our accounts receivable will go down by those two amounts added together to 20 because that amount is no longer owed due to the return. So we're going to knock 220 off that down to 280. Okay, check that we still balance. Yes, we do. And the cost price effect will be half of the revenue price. So we're presuming that that inventory is okay. So we're going to put that back into the inventory card, and that's going to increase how much inventory we have by 900. And we also have cost of sales is being reduced. Now, cost of sales is an expense, so it's kind of a double negative. So we're adding $100 back into our profit. Okay. And again, assets equals L plus OE. 2 to go. So number 3, the business settled an amount owing, dodgy typing there, to a supplier of $800 and they received a discount. So let's start with our accounts payable. We're reducing that balance by 800. So therefore we're going to knock that down to 31,200. We've got a discount. Now that discount is an example of revenue, because what we have here is we've got a liability being reduced thanks to our prompt payment. So it's going to be classified as other revenue. So 5% of 800 is 40. So that's going to top up our profit by $40. So that's going to be 16,315. Okay. And then the total amount paid by our bank balance, impacting our bank balance, will be 760. 800 is the amount settled. We're getting a $40 discount, so that's 760. So if we go to our bank balance, I'm just going to subtract 760 from that, and yes, we're still balancing. Final one, a stock take reveals an inventory gain of 200. So that is going to increase our adjusted GP along with our net profit. So top that up by $200 to 16,515. And our inventory takes a spike up by 200 as well. That is the other account affected. So again, if we look at our assets, our balance sheet, assets equals L plus OE. Every transaction has a minimum of a twofold effect, and the accounting equation always balances along with the balance sheet.